You are making $80,000 a year. Decent salary. You have been responsible, saved some money, and you are finally ready to become a homeowner. So you open a real estate app at midnight on a Tuesday, and every single house that does not look like it is actively falling apart costs at least $400,000. Laminate countertops from 2003. Carpet that stopped being acceptable in the 90s. A basement with fake wood paneling that the listing agent has the nerve to call charming. And yet the bank looked at your income and smiled and said you are approved. Your real estate agent is nodding enthusiastically. Your parents keep asking when you are finally going to stop throwing money away on rent. But here is what nobody in that entire process has any financial incentive to tell you. You cannot actually afford any of those houses. Not in any way that does not turn the next decade of your life into a financial nightmare. And the most dangerous part is that everyone around you is calling it normal. Today, we are going to do something the real estate industry genuinely hates. We are going to calculate what your salary actually buys you. Not what the bank says you qualify for, but what you can legitimately afford without spending the next 10 years eating anxiety for breakfast and praying your car never breaks down. Because there is a massive difference between those two numbers, and understanding that difference might be the most important financial calculation you ever make. Let us start with the reality that almost nobody puts together in one place. The median household income in America right now sits at just under $84,000. Sounds reasonable. Solidly middle class. The kind of income where owning a home should be within reach. But the median home price in America is currently around $415,000. So the system is asking people earning $84,000 a year to somehow comfortably purchase homes that cost 5 times their annual income. And when you point out that this sounds completely insane, everyone has an answer for you. The mortgage broker tells you the numbers work. Someone on the internet tells you to house hack your way to wealth. Your friend from college just bought something so clearly it is possible. The problem is not that you are failing at something achievable. The problem is that everyone is using a different definition of the word affordable than the one that will actually keep your life intact. Here is the definition that matters. There is a guideline in personal finance called the 28% rule. It says you should not spend more than 28% of your gross monthly income on total housing costs. Mortgage payment, property taxes, insurance, HOA fees, all of it combined. 28%. The banks use a completely different number. They will approve you as long as your total debt-to-income ratio stays under 43%. That includes housing plus car payments, student loans, and credit cards. 43%. And here is the thing nobody says out loud. That 43% threshold is not a recommendation for comfortable living. It is the maximum amount of financial stress the bank calculates you can handle before you stop making payments entirely. The bank's job is to make sure the loan does not default immediately. That is it. They are not thinking about whether you can afford groceries. They are not thinking about whether you will have anything left for emergencies or retirement or the basic experience of enjoying your own life. They care that you keep making the minimum payment every month for 30 years. Those are two completely different goals, and confusing them is exactly how people end up house poor. Let us run the real numbers, because this is where the math becomes impossible to argue with. A $400,000 house, below the national median, so we are not even talking about something expensive. You save a 10% down payment, which is $40,000 and probably took you 5 to 7 years to accumulate. You now have a $360,000 loan. At current interest rates, your monthly mortgage payment for principal and interest alone is roughly $2,150. But that is not your housing cost. That is just the beginning. Add property taxes, conservatively around $450 per month, depending on your state. Add homeowners insurance, which has risen 48% nationally since 2020, so budget around $300. Add private mortgage insurance because you did not put 20% down. That is another $275 per month, which is essentially a fee you pay every month for the financial crime of not already being wealthy. And add maintenance. The standard rule is 1% of the home's value per year, which on a $400,000 home is $4,000 annually, or roughly $330 per month. And that is assuming nothing major breaks, which is an adorable assumption about how houses actually work. Add it all up and your total monthly housing cost is not $2,150. It is $3,508. That is the real number. That is what owning this house actually costs every single month before you buy a single bag of groceries. Now apply the 28% rule honestly. To comfortably afford $3,508 per month in housing costs, you need to be earning approximately $150,000 per year. The bank, using their 43% threshold, would approve you with an income as low as $98,000. There is a $52,000 gap between what the bank says you can afford and what you can actually afford without your financial life slowly collapsing around you. And here is the number that makes this devastating. Only about 20% of American households earn $150,000 or more, which means 80% of American households cannot comfortably afford a $400,000 home under any honest financial standard. But $400,000 is below the median home price. We have built a housing market where the typical American home is unaffordable to the typical American household. That is not an opinion. That is arithmetic being brutally indifferent. So what does this actually look like in a real person's life? Not in a spreadsheet, but in the day-to-day experience of someone who bought a house the bank said they could afford. A household earning $80,000 combined saves a 5% down payment on a $400,000 home. They get approved. They move in. They feel like they made it. Here is what actually happens. Their total housing cost lands at just over $3,100 per month. That is 47% of their gross income. But after taxes, $80,000 becomes roughly $4,667 per month in take-home pay. The housing payment consumes $3,100 of that, leaving $1,476 for everything else in their life. Utilities, groceries, car payment, insurance, gas, student loans, health insurance premiums. Those expenses alone typically run around $2,480 per month. They are already over $1,000 short every single month before a single unexpected thing happens. And then the car needs brakes. That is $800 on a credit card. The HVAC unit dies in July. That is $5,000 financed at a rate that makes the original mortgage look generous. This is what house poor means. You technically own a home, but you cannot afford to live in it, maintain it, or experience any version of your life that does not revolve entirely around keeping up with it. Now compare that to what comfortable actually looks like. A household earning $200,000 buys a $500,000 home with a 20% down payment, eliminating the private mortgage insurance entirely. Their total monthly housing costs land at around $3,770, which is 22.5% of their gross income, comfortably under the 28% guideline. After taxes, housing, all living expenses, retirement contributions, and emergency fund savings, their budget balances. That is what the word affordable actually means when applied to a house. And here is what makes this infuriating. That requires being in the top 10% of American earners. For a house that is only 20% above the national median, you need a top 10% income to comfortably afford a slightly above average house. At some point, this stops being a personal finance problem and starts being a structural one. And the generational dimension of this makes it even harder to sit with. Your parents bought a house when they were your age. They keep mentioning it. What they do not fully understand, because the shift happened gradually and nobody announced it, is that they bought a house in a completely different economic universe. In 1980, the median home price was roughly 3 times the median household income. Today, it is 5 times. Your parents were purchasing homes that cost 3 years of their salary. You are being asked to purchase homes that cost 5 years of yours. Yes, interest rates were higher then. Mortgage rates in 1980 peaked near 18%. Monthly payments were genuinely brutal, but the purchase price was actually reachable. They could save a down payment in a few years rather than a decade. And when rates dropped, they could refinance. You cannot refinance the purchase price. There is also the matter of everything else that has changed. College cost a few $100s a year in 1980. The average new car payment was around $150. Many households could qualify for a mortgage on a single income because one parent staying home was financially viable. The comparison your parents are making is not between their situation and yours. It is between 2 different economic realities that happen to share the same country and the same word for a house. Here is where most people's dreams die quietly before they even get to the mortgage application. Saving the down payment. A 20% down payment on a $415,000 home is $83,000. The median household saves roughly 5% of their gross income per year, about $4,000 annually. At that rate, saving $83,000 takes over 20 years. Even with aggressive saving of $1,000 per month, you are looking at nearly 7 years. Meanwhile, home prices are increasing 3 to 5% annually, which means the target is moving away from you faster than you can move toward it. You are trying to catch a bus that keeps accelerating. And the debt you are carrying makes the whole thing harder in ways that are not immediately obvious. Every $250 per month in existing debt payments reduces your mortgage qualification by approximately $40,000. The average student loan payment, the average car payment. If you are carrying both, you may have already significantly reduced the home you can qualify for before you ever walk into a bank, and the home you technically qualify for is already not the home you can comfortably afford. So where does this actually leave you? Let me be direct, because the number of people in this process who will be direct with you is exactly 0. If you are earning less than $140,000 a year and looking at a $500,000 home, the math is not going to work in your favor regardless of what anyone tells you. That is not failure. That is arithmetic. But you do have options that are worth taking seriously. The first is geographic. The same income that barely survives in an expensive coastal market creates a genuinely comfortable life in a different city. $100,000 a year in Pittsburgh, Cleveland, or Atlanta buys a life and a home that the same salary cannot touch in San Francisco or New York. About 20% of remote workers relocated in 2025 specifically because of cost of living. Geographic flexibility, if you have it, is one of the most powerful financial tools available right now. The second option is buying significantly less house than you think you need. Not the house that impresses people. The house that keeps your financial life intact. The difference between a house that consumes 22% of your income and one that consumes 47% is not a cosmetic difference. It is the difference between a life that has room to breathe and one that is one broken appliance away from a crisis. The third option is patience, continuing to rent, saving aggressively, and waiting for your income to grow or the market to shift. Renting is currently cheaper than buying in all 50 of the largest American cities. Every single one. The average mortgage payment exceeds average rent by 38% nationally. If you are renting and feeling like you are making a financially irresponsible choice, the math disagrees with you completely. The bank approved you. Your real estate agent is smiling. Your parents are asking when you are going to stop renting. But you now have something none of them gave you, the actual numbers. And the actual numbers say that what your salary buys in today's housing market is dramatically less than what the process wants you to believe. Understanding that is not pessimism. It is the only foundation on which a genuinely good financial decision can be built. The most expensive thing you can do is buy a house you cannot afford because everyone around you said the math was fine. The math was never fine. And now you know exactly why.